Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back. Wow. Feel free to call us, 216-901-0945. That is the right number here, isn't it? Yeah. 216-901-0945. Getting my phone numbers confused in my head there. But like the man said, this is Bill Bullington, here every Saturday morning from 11 to noon, 1420. Also available as a podcast on 955thefish.com. So I'd like to give a shout out to all those listeners. If you hear something here you'd like to hear again, you can always go there and download it. You can go to my website and download it as well. And by the way, I did update the website. I think I was behind, 3 or 4 weeks. I updated that last week, so all the past shows are up there too. And got a lot of cool stuff to talk about today. I ran a model. In fact, I've been running it now for close to a little over a year. And I just did some more research on it just to be able to put together a little paper that I'm going to make available online to anybody. And I was thinking about calling it Win by Losing. I don't know if that's a good title or not, but what I mean by that was this model that I'm running. And a model, for those of you that are new, is basically a set of guidelines that are going to help you manage a portion of your portfolio. So let's say you decide I have $10,000 or I have $100,000, whatever the number is, and I want to invest it. I'm going to use a particular style or model, or I'm going to find a fund, or I'm going to find an investment advisor that uses these things. And a model is basically a set of criteria that you're going to use to tell you when to buy, when to sell, and how much. So it answers all the questions. Actually, there's another question that answers what to buy or sell, when to buy it, when to sell it, and how much. That's what a model does. It tells you all those things. Some of the more popular models would be the Russell 1000. It would also be the S&P 500. Those are models. Those are basically models and that represent various sectors of the stock market. And you can do almost anything you want, actually. Not that you should, but you can. And I'm going to talk about this model just because I think it's really a good idea. It's very challenging to do from a psychological standpoint, but it's also been very successful. And I do have a phone call coming in right away, so I'll take a break from this. Go to the phone. The answer, we'll come back to these answers in just a second. And also, I just wanted to let everybody know, I did give the laptop away that I promised, and I'm going to have another one to give away at the next workshop. HP, by the way, was discontinuing this model of laptops, and so I got a really good deal on them. I'm going to give one away at the next, probably the next 3 or 4 workshops that we do, because I think it's a really good tool. And we'll come back to that as well, but right now I'm going to go to Brent. And Brent, you have a question or comment for me?
Hey, Bill, Brent, how are you this morning?
Good.
Hey, just want to talk about investor psychology. And I can tell with your experience and temperament, I just wanted you to kind of talk about that.
Okay.
And how it can benefit the general investor out here in, John Q. Public.
Right.
Thanks.
Okay. Yeah, that's a great idea. In fact, a big part of what I was talking about with this model has to do with investor psychology, because it's really the psychology that's most important. The investing success, and I'm sure you've probably heard this before, but it's mostly between your ears. Whether or not you're going to be successful is how you think about things. And I know some people are listening to that and going, oh, that's just psychobabble. Nope. It's real. It's a thing. And having the right temperament is a big part of understanding what you're doing and why. Why are you doing it? Why do you own XYZ company? Well, because it's got all this criteria. Why do you not own the other company? Because it has this criteria, which makes it dangerous. I'll give you a real quick example. Netflix. I love Netflix. That service is phenomenal. The stock, not so much. So I really love the company. The stock, nah. And when you look at how richly that company is valued, I'm obviously not the only one that loves that company, and the other people are voting with their dollars by pushing the stock way beyond the point that it makes any economic sense whatsoever. And does that make sense, kind of?
Yeah. Well, I mean, another thing, like there was an article this morning in one of the publications in Barron's, and it talked about 3 stocks that seem to be largely forgotten and really unloved. And, the first being, and you've mentioned it on your show, is Procter & Gamble.
Yeah. I own that personally, by the way. And I even took that aside from any of my models. I just put it I opened up a regular brokerage account. I'm calling it the Procter & Gamble account. So I have a Procter & Gamble account. And every month I'm adding a little bit of money to that stock because I really like that company, and financially I think it makes perfect sense. I mean, the dividend yield I think is right around 4%. 4%. They've raised that dividend for decades. It said
62 years in a row.
Yeah, and so that would be a classic example of something that I really, really like from an emotional standpoint, but I'm looking at the math, the fact that its price to sales ratio is just slightly over the S&P's long-term average, and it deserves to be there. It actually deserves to be higher than that as far as I'm concerned. And I read about the products that they have. Tide. I just did a load of laundry on my way to the radio show, and I used a couple of packets of Tide. We use their stuff all the time. The fact that they've been so successful for so long, and the way that they go about doing it, and that stuff, that's part of the story, by the way. The numbers justify the purchase, and it's in quite a few of the funds that I own. But I just really like that company, and that's a psychological thing. And I know that's because it's a stock. It could go down 40 or 50%, no sweat, because all stocks do at some point in time. At some point in time, the stock that you love is going to be down 50% or more. And if you can't get your arms around that, then you probably do like Warren Buffett said and stay out of stocks. But the reality is you're probably going to need to be in stocks to be able to make a decent return so that you don't have to go back to work during retirement. Because I know that's what everybody wants to do, right? Go back to work when you're 80. But,
thanks, Bill. Have a great day. Great show.
Thanks for calling. I appreciate it. Bye-bye. And I'm going to go to John. John, you have a question or comment?
Hey, Bill.
Hey.
There's a stock I'd like you to check the tea leaves on and see what you have your comments about it. It's Oak Tree Capital Group, LLC. The ticker is OAK.
Okay. I'll see if I can pull it up here really quickly. It depends on how quick my internet connection is. Sometimes it slows down on me. And what's the symbol again?
OAK.
Okay. Here it comes up, Oak Tree Capital Group. And I'm going to go to their website right now. They're looks like they're out of Phoenix. And I'm just going to their website, mission to deliver superior investment results, risk and conduct business, highest integrity, investment philosophy. These are is this a mutual fund complex?
I don't think so. No, it's a stock.
Oh, credit strategies. Okay, they're making loans. They're doing
yeah, that's it.
That's high. That's interesting. So they had $1.5 billion in revenue the past 12 months. The market cap is $6.2 billion, which puts it at 4 times its annual revenue. I can tell you for that industry, that's a little bit high. That's not super high, but it's a little bit high. The profit margin net profit margin last 12 months was 15.6. That's net after tax, by the way. So,
that's pretty good, isn't it?
Yeah, that's really good. Their revenue growth, it was up about 16%. The dividend yield, 9.65. They're paying out nearly everything they make in the dividend. So basically,
that's why I bought the stock, because of that 9.6.
Yeah, that's a little bit. Just don't be surprised if it goes down. They're interest rate sensitive. All stocks go down. It doesn't matter. The sooner or later, every stock goes down. The stock peaked up around $58 or $61 back in 2014. It's right around 39 now. Now, a high risk lender, that business, by the way, is very profitable, but it's also got a lot of risk to it. It's kind of like flying on a jet. You know, a jet is a pretty safe way to fly most of the time, unless they have a problem. and if you have a small problem on a jet, you know, that ain't good. That's kind of like these guys. That's what happens most of the time. It's a very good business. Most of the time, it'll be extremely profitable. But if they ever have a problem, it ain't good. You know what I'm saying?
Yeah.
So I wouldn't put a tremendous amount of money in that. I'd put a small amount of money in there, and then So,
and hope for the best. Yeah.
Yep.
Okay.
Yeah.
All right. Well, thanks, Bill. I appreciate it.
Thanks for calling.
You're welcome.
Have a good weekend. Yep.
Yes, sir. You too.
Thank you.
Bye-bye.
Yep, and that's one of the reasons, you're not supposed to mention or make recommendations on stocks. And by the way, I wrote about Procter & Gamble in a little paper that I sent out on earnings yield. And I sent it out to everybody that come up to a couple seminars. And we'll be talking about it, the earnings yield thing going forward. And actually, I've got multiple ways of looking at that same thing, and they're doing similar things. So we'll talk about all those, and we are going to, I got to find somebody, by the way, who can, I think I might have located somebody, who can do the record keeping for putting together an investment club, because I'm going to form that. I think it's going to be fun, really fun. But I can't do the paperwork. I mean, I can show up and contribute to the meetings, set the guidelines, do all that kind of stuff. Heck, I'm even going to pay the guy to do the accounting for the investment club. And this is the kind of stuff we're going to do, because I just really like this. I mean, this is one of the few hobbies in the world where you can make money. Most hobbies cost you money. Some hobbies cost you a whole lot of money, especially if your hobby involves the opposite sex. That can cost you an enormous amount of money. I'm just kidding. Kind of. But anyway, we'll be looking at these kinds of things. So Procter & Gamble, by the way, $66 billion in revenue. Market cap's $184 billion. That's right around three times sales. Not unusual, particularly for somebody with a profit margin of 15% net after tax over the past 12 months. And their average is somewhere between 10 and 15 long term. So it's right around where it normally is. They've been shedding some of their lines that are not as profitable, which is what a good business management team does. They take a look at the businesses that they're in. If any are suffering and they don't think they can repair that, they have an obligation to shut that down. Yeah, a lot of people don't like to hear that, and I understand. But if you are staying in businesses that are costing you money, that's not what you hire a management team to do. You hire them to swallow hard, do the right thing, and cut back or exit certain businesses that are not profitable anymore. And I look at my own practice. There are a lot of things that we used to do that we don't do anymore because they're just not profitable. So anyway, all this stuff has to do with investing, developing your mindset. As the caller called in and talked about, investing is really, it's a psychological experiment. You have to design some sort of a framework for yourself. It doesn't have to be complicated. In fact, you're more likely to be successful if your strategies aren't that complicated. I'll give you a couple of examples. The Russell 1000 is an index comprised of the largest 1,000 companies by size. They invest in those companies proportional to the size that the company makes up of if you add them all together, if you added the values of all the companies together, and let's say XYZ company's 3% of the total, well, they put 3% into that company. It's called market cap weighting. That's the strategy. That strategy does incredibly well. Over time, it's done very well. Despite the fact that you're putting more money into the bigger companies just because they're bigger. That, in my mind, that's okay, but it makes me a little bit uncomfortable because then you get companies like a Netflix who are receiving a larger than average share of that index or that strategy or that portfolio because they're so big, and it doesn't have anything to do with the value. It's just the share price. See, that to me makes me uncomfortable. So I'll never be successful investing that way because I'm uncomfortable investing that way. And when it goes down 40 or 50%, I'm going to be kicking myself and saying, I knew I shouldn't have done that, and all the other things that we all do when something like that happens. And I'd rather do something that makes more sense to me. And I'll give an example. We start off by talking about a strategy that I did a little research on, had been running some money with, made a slight adjustment here lately. Not lately, it's about almost a year ago now. And this strategy ranks the top 1,500 companies instead of the top 1,000. And out of those top 1,500 companies, I take those that have the highest level of operating income relative to the amount that you would pay for buying the entire business. Now, let me say that in English for you. If you were the owner of that company, you're taking those companies that are generating the most cash per dollar that you're paying. So, and if you're thinking about it, and you can even convert it into a yield by dividing that estimate of cash flow by the cost of buying the business, which we call the enterprise value. So you can convert that into a yield, and now you can compare one company to another company. So if you compare two companies and you get a yield of 10% on one, and another one's only yielding 5%, which one do you want to own? Obviously the 10%. Now that makes perfect sense to me. I am so comfortable with that. You're going to have to wait to hear how comfortable after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. I'll be right back.
If it was all about religion, what to do, what to say, what to wear on a Sunday, all about perfection, black and white.
And we're back. Hey, if you'd like to call in, 216-901-0945, 216-901-0945. We're just talking about a whole ton of things today. Feel free to offer up a subject for us. I was talking about a particular strategy that I really like a lot. This thing fits my personality so well. Actually, it fits one of my personalities. I have multiple personalities, not in a bad way. Actually, yeah, we'll talk a little bit about that in just a second. But before I do that, I got to bring Dan on, and I think, hey, Dan, are you there?
Yes, I am, Bill. Good morning to you.
How are you?
I'm doing just fine. Sitting here watching one of God's wonderful little animals that doesn't have very many brains. Ducks are not very smart animals. They're cute, but
yep,
they just talk about follow the leader.
Yeah.
Boy, they walk right. One walks into trouble, they all walk into trouble.
Yeah, it's pretty funny. And you know what cracks me up is all those signs that show like the duck crossing. I'm pretty sure the ducks don't know how to read.
I don't think they do neither. But I'll tell you, sometimes you just wonder about them.
Yeah.
But chickens are kind of smarter.
Yeah.
They're a lot smarter for some reason. But you never see chicken crossing signs.
Hey, turkeys are super smart.
Are they?
Yep, absolutely. You should Google that. See how smart those birds are. Yeah, that's a big misnomer when people used to call each other turkeys. I mean, that was actually a compliment.
Oh, I never realized
and
that.
by the way, the
That.
turkey came in second behind the bald eagle when they were going to vote for the bird that was going to represent America.
Really?
It came in number
That's
2.
interesting.
So,
Oh, wow. A turkey.
and by the way, we were almost speaking German because German was the second language came up in the voting too. English happened to beat them out by a little bit.
Wow.
But yeah, it's amazing all the kind of stuff that's out there.
Yeah.
What's really amazing is all the history at the Cleveland Grays Museum.
Yes, there is. Speaking of which, it's 2 weeks from this Saturday, June 2nd, the Cornerstone celebration for the Cleveland Grays, celebrating their 125th year at that location at 1234 Bolivar, right across from Playhouse Square.
Yep.
And we have an open house from 12 to 4. We'll be doing tours of the building. And if people ever been down to Playhouse Square and they look at that big red castle building on the corner of 14th, that is us. And a lot of people don't realize that.
No, I passed that for decades, and I always thought, what? They built a castle down here, and nobody knows what it is. And then I happened to come across, I think it was Joe Andriolo that said, "Hey, you should come out to the Cleveland Grays." And where is that? It's that building that looks like a castle. And I was like, really? Yeah. I'm dying to go in and see what that looks like. And that's. How cool is that? It's a free event. How many things can you do for free anymore?
Exactly. And the building actually built 125 years ago. It had the first Cleveland Symphonic Orchestra played there for the very first time. The first auto shows in the city of Cleveland were there.
Sousa used to direct the...
yes.
Yeah. It is. There is so much history in that building. It's such a phenomenal Cleveland landmark, and and again, it's free. The thing that really amazes me is when you go in and you look at the woodwork in there that was all made in the late 1800s, was all made by hand.
Yes, it's fantastic, and there's 3 floors, so it's a very, very neat place to tour, and we're going to be open for tours that Saturday, June 2nd. From 12 to 4. And along that, we are going to have a bunch of other people down there to help celebrate us. The National Guard will be there, the USS Cod, and the Western Reserve Theatrical Organ Society will be playing their Wurlitzer organ.
Oh, wow.
Which goes back to about 1910,
yep.
Which kids don't realize before the talkies came around that when you went to the movie theater, there was no sound, so they had an organ that played the music according to the motion picture, and we have one of those there, and they will be putting on performances throughout the day from 12 to 4. So
I think you got to go down there. And by the way, you're thinking about getting married. The hall's available for that as well, so this would be a good chance to go in and really take a good look at that.
Oh, it's tremendous for weddings because of the different floors we have. Our drill floor can hold 400 people.
Yeah.
So, we can do large and small events because the second and third week we do smaller events up on the second and third floor. So we're always open for weddings, meetings, concerts, small concerts, charitable organizations come in and have their functions there. So the building is getting more and more use and getting more and more recognition. Yeah. But after 125 years in that location, I'm glad to see it happening.
Yep. That's awesome.
Yeah.
Yep.
Yeah, and like I told you last week, the Federal Reserve is going to be there with a war bond exhibit. So we even talked them into coming down to take a look.
And this whole thing is free. And when is it again?
June 2nd from 12 to 4.
Okay, and that's a Saturday, correct?
And it is a Saturday. It's 2 weeks from today. And if anybody wants more information about the Cleveland Grays, they can go to graysarmory.com and look us up, because during the year we have a speaking circuit where we have a variety of speakers that come in for free and do a lot of different presentations. And we have a hashtag now, and the hashtag would be Downtown Castle.
Oh, yeah, that's pretty neat. That's awesome.
Yeah, so we're we're trying to get ourselves out there a little bit. We're too well kept secret.
Yep.
We got to let more people know about us.
Absolutely. Well, hey, thanks for calling in again and talking about this. And let's do it again next week, and we'll hope for a big turnout there. It is a really good event, and I can't believe it's free.
People will enjoy themselves. It will be. It is a building to be seen. And in fact, I think we're in like the top 3 oldest organizations and buildings in the city of Cleveland.
Oh, neat.
Old Stone Church, I think, has been around a little bit longer than us, but there isn't too many organizations or buildings older than we are. So people will appreciate it when they come see us.
Yep. Cool.
Once again, I thank you for having me on, Phil, and you have a good week.
Thanks, you too. Thanks for calling. We'll talk to you next week.
Okay, bye-bye. Thank you.
And I'm going to go right to Carl. Carl, you have a question or comment?
Yeah, hi, Bill. Say, I wanted to get your thought on AT&T stock. What do you think it's a buy at these prices?
I own it because it's in one of my models. Okay, so if it's in the model, then it's in my portfolio. So I don't I wouldn't say I own a lot of it because it only makes up about 2%. I'm really getting some feedback here. I don't know what's going on. Oh, are we on speaker?
I'm in my car. I'm talking to you through the Bluetooth.
Oh, okay.
Car.
Yeah, that's what's doing it. We're getting a little bit of interference here, but AT&T is okay as a holding. I don't really have an opinion on it. Actually, my opinion's not that high on the telecommunications companies because Google's coming in and Google's going to change that entire industry. And I'll talk a little bit more about that, but I own it in one of the portfolios. It's just not a big position for me. So, and the reason that it's in there is because of the dividend yield.
Yeah, that's what I find kind of attractive at this point right now.
Yeah, just don't put more than 2% of your money in there, though.
Okay, very good.
Okay, all right. Thanks.
Thank you, Bill.
Yep. Bye. Yeah, I own it. It's in my high dividend model, and and that's part of the discipline. An awful lot of people will say, "Well, you must not really like it that much." Well, actually, I'm just running the model. The model is designed to do a certain thing. It's actually designed to buy the highest dividend yielding stocks in each of their sectors, and there are 44 stocks in that whole model. So I've got less than 2% in each one of those stocks, and that does not make up more than 20% of my stock portfolio. So if AT&T doesn't do well, it's really not going to hurt me that bad. In the meantime, it's paying a 6% dividend. Now, that's how you win by not losing too much. And I don't know what AT&T is going to do. I can tell you that industry is really undergoing through some major change. And in the end, I think it's good. I think that some big, large companies are actually going to go away over the next few years. I don't know who they are, and if I did, I would try to avoid them. So in the meantime, as long as they can keep paying the dividend, they'll keep qualifying to stay in that model. If they ever cut the dividend, or if the share price goes up so much that the dividend yield drops really low, it will be out of the model. So I don't have to know what's going to happen in the future because I already have a plan for everything that could happen. And that's called investment planning. And investment planning is the second most important part of your financial plan. You can write that down and say you heard it here. Investment planning is the second most important part of a financial plan. The first most important part is when you're young, living beneath your means. That's the first most important part. And when you get to the point where you're retired, it's not spending too much so that you spend yourself, that you run out of money. So it's your spending and budgeting is first and foremost. Number 2 is investment planning. Number 3 is estate planning. Number 4, tax planning. Tax planning is important. It's in the top 4. It's not the most important. A lot of planners make the mistake. A lot of tax preparers make a lot of mistakes by focusing too heavily on the taxes. Well, there comes a point when avoiding paying taxes hurts your investment performance. So if you get another dollar and you have to pay taxes on it, oh, well, you've paid a little bit more in taxes, but it's because you made another dollar. Do you understand? You get to keep the rest of that dollar. Okay. That's an increase in your income. So you can't let the tax dog wag the tail, or tax tail wag the dog. That's it. A tax tail shouldn't wag the dog. Oh, that should go up there with some of George Bush's malaise. What was that one? I always laugh so hard when I see it. Every once in a while, I need a good laugh. I'll go to YouTube and I'll pull up George Bush when he says, "Fool me once, shame on you. Fool me twice, shame on you. Fool me can't fool me again." See, he just forgotten, the rest of that thing. Anyway, maybe it wasn't that funny. But if you'd like to call us, 216-901-0945, 216-901-0945. And again, I started off talking about this strategy and how strategies really need to make sense for you, because all strategies sooner or later are going to lag, say, the popular indexes. They won't make as much money in a year or two. In fact, the one that I'm talking about over the past 10 years, now this is in back testing, by the way, and there's a whole disclaimer on back testing that's about 2 minutes long. In fact, wait till the end of the show, you'll hear it. But back testing is something you do to try to test something before you put real money into it. You're going to run some hypothetical examples. And so I went back to 10 years. Actually, I went from 2007 to 2017 because we're not through 2018 yet. And I looked at this and I compared this model where you would take the largest 1,500 companies and you take the amount of cash that the operating income. So if you're an accountant, you know what that is. If you're not, go to Investopedia. It's a measure of cash flow. Is it the perfect measure? No, there's no perfect measure. Okay, but I like this one a lot. It's much harder to manipulate than earnings are. It's incredibly difficult to manipulate relative to how earnings can be manipulated. Okay, so it gives me a clearer picture. Makes it a little easier to compare one company to another. So that's what I'm using. So earnings before income, before interest or taxes. Some people call it operating income. And I realize there are some small situations where there is a slight difference. Okay, that doesn't happen that frequently or frequently enough to make me want to change the formula to adjust for that. So now I will look at each stock and check for that individually before I actually buy these things. But having said that, if you were to take the EBIT or operating income, that's a measure of cash flow, You divide it by the enterprise value, which is the cost of buying the entire business. It converts that into a yield so that you can compare companies against one another on a more fair basis. The idea is that you want those that have the highest yields. Pretty simple, right? So out of the 1,500, we're going to take 30. And again, this is just a model. When I first did this, I was using 100 stocks, and I cut it down to 50, and then I decided that I would cut it down to 30. Okay, so you take the top 30 stocks. If you were to do that once every 6 months, if you had done that over the past, from 2007 to 2017, a 10-year time period, every dollar that you invested, now I'm not assuming that you paid any fees. Fees would reduce this by whatever the fees are. Okay. But just to see if it works, I did it without the fees, and a dollar would be $3.42 today, or would have been $3.42. So I got to come back and finish the rest of that after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because I will be right back.
This world can be cold and bitter. It feels like we're in the dead of winter, waiting on something better. But am I really gonna hide forever? Over and over again, I hear your voice.
And we're back. Hey, if you've got a question, you can always call us today, 216-901-0945, or you can email me, bill@bullingtoncapital.com, or you can go to my website at bullingtoncapital.com, click on the Contact Us page. We will be glad to try to get back to you as quick as we can. And other than that, we haven't actually set a new seminar date yet. We will get that up here sometime this week. And, we're kind of always focusing on investment management, trying to improve ourselves constantly, building new models, testing old ones. A lot of the old ones, by the way, they've really kicked back in over the past few months. So that's been a sight for sore eyes, because I can tell you, every single investment model you can think of is going to lag the market at some point in time. They all do. In fact, the one that I was just talking about, the one that I really like a lot, I'm really comfortable with this model. It makes me feel really good to manage my money this way, even though 6 out of the last 10 years, it lagged the market. 6 out of the so 60% of the time, it lagged the market. Now, here's the thing. Almost all strategies will lag the market at least 50% of the time or so. And that's normal. That's absolutely normal. But if you didn't know that, then you'd probably be upset by that. And being upset is not a good way to invest. It's really difficult to maintain your composure when something's happening that you did not expect. And when something happens that you didn't expect, you're normally getting a little upset. And that boils up long enough, and people will abandon it. In fact, this strategy over the last, the 4 years, 2014 through 2017, 3 out of the 4 years, it underperformed. And if you didn't know that could happen, that would make you incredibly upset. Now, it didn't underperform by a lot. And some people think it does. Market's up. Whenever the market's up, I don't know. Here, let's take a look here. No, actually. Yeah, you're down 8.5% in 2015, and the market's up, just under 1% that year. A lot of people are going, hey, yeah, that's actually normal. They don't want to hear that. Okay, now the next year it came ripping back, and did almost twice what the market did. So that's kind of how that works. That's just how that works. Every portfolio manager that's ever had a better long-term track record than the market indexes has underperformed 2-3 years in a row, typically more than once, sometimes for even longer than that. So yeah, the market is going to test your patience. It's going to test your patience. That's why it's really important to know really well your strategies. What are you doing? And if you don't, if you have an advisor and you're upset, call them, talk to them. If you're one of my clients, call me or call her and talk to us, because I'm sure there's probably a really good, reasonable explanation. And it's just that you're not aware of it, because they don't really teach this. This is still not being taught in business school. This is still not being taught in the portfolio management schools, because I have kids going to college that are asking me, kids in grad school that are asking me, like, wow, you guys, they're still not getting around to this? Why aren't they doing that? I guess you probably have to become a CFA to be able to do that. By the way, CFA is kind of like a CPA, except it's in investing. And a lot of the stuff that they're teaching, incidentally, is it doesn't work that well in the real world, but you get enough education there that you can figure out what does. Okay, so in defense of that program, they do teach you enough to be able to go out and build models intelligently. And I think if you're running millions of dollars, if you've got hundreds of millions of dollars to manage, you can't do models like the one I'm talking about right now. It's not going to work for you. You're too big. So these models generally work best for people who aren't dealing with hundreds of millions of dollars. If you are dealing with hundreds of millions of dollars, if you're a foundation or an endowment out there, then yeah, you're going to have to use some other strategies. And by the way, there are lots of great strategies out there. None of them beat the market every year. the various categories have a tendency to perform well at the same time together. Look at anything that's got the word momentum in it over the past 18 months. Just check it out. Do yourself a favor. If you're out there screening through mutual funds or ETFs, use the ones with put momentum in your search and look at the performance of those. It's been in favor. Now, go past the last 18 months to the 2 years prior to that. You're going to wish you'd never heard of those. And that's just the way it goes. They were they were out of sync or just out of their cycles. The cycles have kicked back in, and now they're doing incredibly well. Okay, so it's just a cyclical thing. And if you really knew a lot about financial markets, you would know that. And one other thing I wanted to kind of talk about today, we do financial planning at Bullington Capital Management. Typically focuses around retirement planning. And the plans that I like to construct for people are generally pretty simple. Now, some people like to take a look at things on a granular level. They like to take a look at every expense in the household, put it down in a spreadsheet, track it extremely closely. And I appreciate that. It's not the way that I like to do planning. I'd rather do goal-based planning. Say, okay, I'm going to let you do the budget, and once you've got your budget, and I'm going to tell you based on the assets you have under management and how much risk you want to take, what you can afford. So now you can take that budget, and if it fits within that, that's great. If it doesn't fit within that, you're going to have to go back and change your budget because you can't, or we can increase the risk to try to increase the returns. That's generally not a great idea, but at least you would know. Now, actually doing that budget is not something that I'm really fond of doing. We can do it. And if we do it, it's expensive. Because you're taking, it takes a lot of time to do that stuff, and we've got to do that. So we're going to do that together. Now, there is a firm out there that does a great job at doing that kind of stuff, that really likes to do it, and it's called the Estate Planning Team. And they have a show on this station, comes on early in the morning, and they really like that. They call it cash flow planning. That's what we all call it. What if I wanted to take this vacation in 2019 in July? And those guys will do that. They've got their own proprietary software. They built it themselves. And they'll do that. Now, if we do it, it's going to be more expensive than if they do it. Okay, so I'll just tell you, we do that type of planning. It's just that we don't have a lot of people that actually really need it. And for those people that do really, really want that, I'm going to tell you that the estate planning team is going to be less expensive than we are. So you might want to give them a call. Like I said, I looked at it. I thought about it. It's retirement planning is nowhere near as difficult as the College for Financial Planning wants to let you believe it is. You have to take into account an awful lot of things, but you know what? In the long run, you can't plan for everything that's going to happen in your life. It just doesn't work that way. So your plan has got to be kind of flexible. If you're not building flexibility into the plan, which means that you're going to take some of the details and go, okay, well, if that happens, then we've got this much wiggle room in the plan. But you can't say, okay, I'm going to die, September 18th, 2047, and that's the date. Because you just don't know that. I mean, hopefully you don't know that. I don't know what. Yeah, well, I'll leave that alone. But there are lots of things that can happen that you just can't plan for. So you try to do the best you can. Medical expenses are extremely high, going higher. They're outpacing inflation by a wide dollar amount and wide margin. So you factor that into your budget. That goes into your budgeting. Okay, and here's a really good tip for you. Whatever you're living on now, you can probably live on 80 to 85% of that without cutting back on your lifestyle. If you don't know how to budget, just take your current income, multiply it by 80, and that will be you could live on that without impacting your lifestyle that much. And I know a lot of people going, wait a minute, 80%, that's a 20% cut. You will not be paying Social Security at that point in time, which is going to be about 7.5%. And if you're self-employed like I am, it's 15%. So 80% is probably too high for me. It is too high for me. I have to pay 15% of my income to Social Security. Well, not all of it, but because it caps out at a certain level. So, but that being said, you're also saving some money. So if you take that out, you're not going to be saving anymore. You're going to be spending. Okay, you take that out, the vast majority of people could get by on 80%. Now, everybody's going to be a little bit different. So that's something that we would do in a planning meeting, is discuss that. And I guess we're going to have to discuss that on a different show because the music telling me the show is over is playing. So you're listening to Bill Bullington, and I'm here every Saturday morning from 11 to noon, 1420 The Answer. Go to my website, bullingtoncapital.com, to contact us if you'd like to. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.